Imagine doing everything right, still losing half your life savings. No gambling, no bad investments, no reckless bets, just patience, discipline, and trust. Let me tell you about a woman we'll call her Eleanor. She lived in a quiet suburb in the American Midwest, taught elementary school for 3 decades. She never missed a payment and never carried debt longer than necessary. Her finances were a picture of responsibility. Government bonds, a pension, a life insurance policy, and a savings account she rarely touched. If financial responsibility were a religion, Eleanor was devout. One Sunday night in August 1971, her favorite television program was interrupted. The President of the United States appeared on screen. He had a calm voice, a steady tone, and a reassuring smile. He used the word temporary. He said the dollar would remain strong. He said Americans had nothing to fear. Eleanor believed him. Why wouldn't she? Over the next 9 years, something strange happened. Without a market crash, without a single bank collapse, without any dramatic headlines screaming disaster, Eleanor quietly lost nearly half of her purchasing power. Nothing was ever stolen from her account, but almost everything was taken, not through fraud, but through inflation. What most people still don't understand is this. The 1970s weren't just a bad decade. They were the moment the entire global monetary system changed forever. Before 1971, the world ran on a structure. Currencies were anchored. The US dollar was tied directly to gold. Other major currencies were then tied to the dollar. This created limits, constraints, a kind of financial gravity. Then, in one weekend, that anchor was cut loose. Behind closed doors, policymakers realized the math just didn't work anymore. Too many dollars had been created, and too much gold was being demanded in exchange for them. Foreign governments were lining up, wanting to trade their paper dollars for real metal. The system couldn't hold, so it was severed. Publicly, the move was described as temporary, but it was never reversed. From that moment on, every major currency in the world began to float on confidence alone. And as we all know, confidence can be fragile. This wasn't just an American issue, it was global. Major economies stumbled as inflation surged across continents. Even nations known for their monetary discipline like Germany and Switzerland struggled to contain the rising prices. There was no perfect paper refuge. Yes, some currencies performed better than others, but the entire world had stepped into a brand new experiment, money backed only by policy and promises. Now here's the part that most history summaries skip. While savers like Eleanor watched their bank balances slowly rise in nominal terms, the numbers on the screen went up. What those balances could actually buy was shrinking, year after year after year. If you had $100,000 saved at the start of the decade and left it untouched in a savings account, by 1980 you would have had more dollars on paper. But those dollars would buy dramatically less gasoline, less food, less everything. It felt safe, but it wasn't. Fixed pensions paid out the same checks. Bonds paid the same coupons. Insurance policies promised the same payouts. But inflation cut through all of them like rust through steel. Silently, that most dangerous financial damage doesn't arrive with sirens and flashing lights. It arrives politely. But here's what separates the observers from the participants. A small group of analysts, long before 1971, had studied monetary history deeply. They understood a fundamental principle. When governments detach money from physical constraints, expansion always follows. And when that expansion outruns real production, purchasing power inevitably falls. These people weren't insiders. They weren't powerful policymakers. They were simply students of history. They recommended gold when it was deeply unfashionable. They warned that a devaluation of the currency wasn't just a possibility, it was a probability. Of course, they were dismissed as pessimists. But in the end, they were right. When gold was finally allowed to trade freely again, it didn't just spike, it repriced. What had been fixed artificially was finally allowed to reflect the new monetary reality. By 1980, the price of gold had multiplied many times over. But here's an overlooked detail that should really make you pause. For several years after the system changed, ordinary Americans were not legally permitted to own gold bullion. During the exact window when that monetary protection was needed most, access to it was restricted. By the time those restrictions were finally lifted, the price had already surged. The protection existed, but the timing of access was everything. So let's talk about what actually worked during that lost decade. Assets tied to physical scarcity held their value, two commodities rose. Real estate, especially when financed with fixed-rate debt, performed exceptionally well. This wasn't because houses magically became more productive, but because inflation eroded the real value of the loan attached to them. If you borrowed money at a fixed rate before inflation took off, you were effectively repaying that loan with cheaper and cheaper dollars every single year. Inflation punished savers, but it rewarded debtors with fixed obligations. Savings accounts did not keep up. Long-term government bonds, the very things marketed as safe, produced negative real returns. They were slowly hollowed out from the inside. That chaotic decade only came to an end when one central banker, Paul Volcker, decided the pain of the cure would be less than the pain of the disease. Interest rates were surged to levels that today feel almost impossible. Mortgage rates climbed into the high teens. The economy was deliberately pushed into a deep recession, and then another one. Unemployment spiked. There were protests, political backlash, and widespread anger. But it worked. Inflation finally broke. And once confidence in monetary policy was restored, gold peaked and began its long descent. That's the pattern. Gold tends to rise when trust in the system erodes. It tends to fall when trust is restored. It's not about panic, it's about credibility. Now let's step back and look at our world today. Government debt levels are at historically elevated levels. Interest payments on that debt are consuming enormous portions of national budgets. And what are central banks doing? Quietly, steadily, they have been accumulating gold at record levels in recent years. It's not financial commentators, not YouTubers, but the central banks themselves. These institutions hedge for structural reasons, not emotional ones. And that brings us back to Eleanor. She trusted the system because she had been given every reason to. She believed bonds were safe. She believed her pension was guaranteed. She believed that responsible saving meant lifelong security. She was not foolish. She simply did not understand the crucial difference between nominal value and real value. The difference between the number on the page and what it can actually buy. The difference between a promise and an anchor. When a monetary system loses its anchor, paper assets depend entirely on policy discipline. If that discipline weakens, even slightly, the erosion begins. Not overnight, not dramatically, but persistently. And here is the uncomfortable truth. Most people only recognize a major monetary change after it has already repriced everything around them. They notice the grocery bill first, and the insurance premiums, then the cost of housing. Only much later do they look at their savings and realize their money didn't fail them. The unit of account they were saving in was what changed. This isn't about predicting doom and gloom. It's about understanding structure. When money is anchored, stability is enforced externally. When money floats, credibility must replace that constraint. And credibility can always be tested. The people who preserved their wealth in the 1970s were not geniuses. They simply diversified outside of assets based on fixed nominal promises. They owned things tied to reality scarcity, production, tangible value. They understood that inflation is not an event, it's a transfer. A slow, silent redistribution of wealth from the savers of paper to the holders of real assets. So, ask yourself one question. If purchasing power began eroding tomorrow, not through a sudden crisis, not through a collapse, but through steady, persistent inflation, would you notice it early? Or would you, like Eleanor, wake up years later and realize that nothing dramatic ever seemed to happen? Yet half of your buying power had quietly disappeared. History doesn't repeat itself in the exact same way, but it often rhymes in structure. When the anchors are cut, paper drifts. Some assets will float along with policy, while others sit beneath it waiting. The question isn't whether systems will change. They always do. The question is whether you recognize the shift while it's still happening, or only after it's done. Thanks for watching. If you found this perspective valuable, consider subscribing for more insights into how these big picture changes can affect your financial life.